Welcome to our 6-Minute Strategy from me, Guy Monson. I'm recording this session from the studios of the wonderful Itch Media today, as we at Sarasin prepare to move to our new offices at 50 George Street. The past 12 months have delivered an extraordinary sequence of geopolitical shocks, mostly coming directly or indirectly from the Trump White House. They began with the highest US tariffs in 80 years and ended in proposals to apply punitive tariffs on European countries that disagreed with the possible annexation of Greenland. In almost every one of these instances, though, including even the bombing of Iran's nuclear facilities, risk assets have actually rallied. Global equities, emerging markets, credit and commodities all climbed, while the dollar has typically fallen. It looks as if this same relief rally may occur with a settlement on Greenland too. This time around, though, equity valuations are higher, credit spreads are narrower, and Trump's latest clash with Europe appears more deep-seated. The question then is whether the extraordinary resilience of risk assets that we saw in 2025 can now be sustained into 2026. We'll look at the arguments on both sides in the slides ahead. So let's begin by looking at a chart from the famous Fund Manager Survey of Bank of America. And they've here asked their fund managers the following question. How likely do you think it is that the economy in this region will see a recession over the next 12 months? And you can see from the blue line global and red line Europe that they think it's extremely unlikely there's a potential recession. So why, against this harsh geopolitical backdrop, are fund managers so confident of underlying growth? Well, I think there's three reasons. First of all, with sticky inflation, nominal GDP, that's unadjusted for inflation, remains robust. And that, of course, is good for profits, it's good for earnings, it's good for turnover in the overall economy. So it's a good backdrop for risk assets, particularly developed in emerging market equities. Secondly, today, the geopolitics are messy, but they're still not likely to disrupt markets for now. Yes, the dollar is becoming more weaponized. The payment system in the US is really encouraging people to try and escape and buy gold if their countries in any way that might have a dispute with the US. So yes, we're overweight gold and metals, but it's not at the moment really driving a threat to world growth. Finally, AI, despite all the challenges, remains in the driving seat economically and is making important contributions to GDP growth and market returns. And those AI opportunities are gradually widening out across sectors: power, utilities, service industries, the list goes on. So let's drill down a little bit to some of the market factors which are really at play. First of all, the tariff tempo is reducing. If you look at that left-hand panel from empirical research there, you can see the original tariff rate that Trump envisaged in the Rose Garden back in April. That was a little over 20%. That's come down now to more like 14 or 15%, and if you include the settlement with China and the reduction in some foodstuffs, which Trump has reduced tariffs on to hold down domestic prices, that number is beginning to fall to close to 10 or 11%. So the bark of these tariffs is a little worse than its bite. What's that meaning, of course, is that actually a bit of growth is coming back into the system and optimism improving. Look on the right side, the tick up in the services PMI, the famous ISM survey, above 50 is expansion beginning to move, and possibly a bottoming out of the consumer sentiment numbers, which is something that worries Trump so much in the midterm elections. The second factor that I think is important in underpinning growth is that even with debt funding rising as these hyperscalers in the AI world put in these huge investments in data centers, leverage is still very well controlled. On the left-hand panel there you can see for the four great hyperscalers, Microsoft, Amazon, Alphabet and Meta, all of them are seeing cash flow improve and continue to climb. It's exceptionally strong already. Their borrowings are coming in, but they're modest. They're less than 30 to 35% of debt to equity ratio. And the yield they're paying is very attractive. That means that earnings can continue despite the huge investments into data centers. And we can see that on the right in the year ahead. We've got a great number for global earnings growth of around 16%, but look at those Mag 7 numbers coming in at about 35%, obviously flattered by Nvidia. That earnings driver is still there. Thirdly, looking to China, yes, the domestic economy is still in some trouble. Property prices continue to decline. But if you look on the left-hand panel, this is exports that are Chinese foreign trade exports by region. Exports to Europe and Asia are really climbing strongly, upwards of 11%, particularly autos and climate-related investments. Yes, we've seen a big drop in the US, down 30%. That's obviously Trump's tariffs. On the right hand, what does that mean? It means Chinese growth is broadly stable because that light blue line, exports, is strong, and capital formation will probably improve as some sort of subsidy program comes in. And yes, according to government, they've hit their 5% GDP target for 2025. Fourthly and finally, gold seems to be absorbing a lot of the risk assets with relatively little disruption. As you see here on the right-hand panel, foreign ownership of privately held US treasuries is falling, and that money is going into gold as the share of gold in total reserves rise strongly. That's underlying the price. So gold appears to be absorbing some of the tension in global markets. So let's wrap this up in terms of asset allocation. We're underweight government bonds. We simply don't see today's yields compensating investors enough for stubbornly high government deficits. We also see spreads that are near record lows. In equities, we're overweight. We like those one-year forward earnings numbers, strong buybacks and dividend growth. But we're aware, of course, of the risks of high valuations. Where appropriate, we can use portfolio insurance. In alternatives, we favour absolute return funds. We have our big position in gold. We just added a position in transition metals, ones that really benefit from the move to the electrified economy and the AI growth. In cash, we're underweight, particularly the US dollar, our favoured currency areas being the euro and emerging markets. So I hope that's helpful. I hope it's given you an understanding of why markets can be robust despite the geopolitics. And apologies from me, I'm over 6 minutes.